Today is April 10, 2026. This is your Friday read. Markets opened this morning with a clear alert gap. The reason for it is simple and direct. Oil, stocks, the global economy, is the Strait of Hormuz. What happens there is setting the tone for everything else. This vital waterway, a choke point for a massive share of the world's energy, now has strict limits. That single fact has cascaded through financial markets, forcing everyone from central bankers to everyday investors to pay very close attention to the news flow. The big change came into sharp focus this week. The war in the Middle East has severely cut down the flow of crude oil and other products through the strait. This is not a minor disruption. The International Energy Agency, a global energy watchdog, has called this the largest supply disruption in the history of the oil market. Before the conflict escalated, this narrow channel saw nearly 20 million barrels of oil pass through it every single day. Now that immense flow has been reduced to a mere trickle, a fraction of its former volume. This has forced a major reassessment of the energy landscape. On Tuesday, President Trump announced a potential 2-week ceasefire. The deal was contingent on one critical condition. Iran had to reopen the Strait of Hormuz to normal traffic. Hopes for a quick resolution rose. However, by the following day, the reality on the water was different. The strait remained effectively closed. Reports indicated that Iran was still limiting the number of ships allowed to pass, creating a bottleneck that kept the global supply chain under immense pressure. The market's reaction to this fragile ceasefire was mixed. Brief relief gave way as access remained unresolved. In response to the disruption, official forecasts have been radically altered. The United States Energy Information Administration, or EIA, made a significant revision. It sharply raised its oil price forecast for 2026, a clear signal of expected tightness. The agency now projects the average price for Brent crude to be around $96 per barrel for the year. This is a substantial increase from its previous forecast of just under $79. The EIA also lifted its outlook for West Texas Intermediate to about $87 per barrel. That was up from an earlier estimate near $74. These revised numbers reflect a stark new reality of constrained supply. It's not just about the ships that cannot pass through the strait, it is also about the oil that is not even being produced. Gulf countries have slashed total oil production by at least 10 million barrels per day. Producers have been forced to shut in wells, taking even more oil off the market. The EIA reported shut-ins averaged about 7.5 million barrels per day in March. They project a peak around 9.1 million barrels per day in April, before gradually declining over the coming months. The market's price reaction has been swift and severe. As disruptions mounted, Brent futures soared. They traded within a whisker of $120 a barrel, a level that strains economies. Brent average in March, about $103 a barrel. Volatility was extreme. Daily swings peaked near 128 on April 2nd. These aren't just numbers, they mean rising costs for businesses and for consumers worldwide. Even with ceasefire news, prices stayed high. Thursday. Market priced in Iran, still controlling access to the strait. Brent rose about 1% to about $97 a barrel. West Texas Intermediate climbed over 3%, settling near 98 after briefly topping 100. The market is nervous. Prices react to every signal, every headline, every rumor, every diplomatic signal. Analysts are modeling more extreme scenarios. Oxford Economics ran a simulation, 140 a barrel, average for 2 months. They called it a potential breaking point with Eurozone contraction. Some now even debate a remote $200 scenario. In the face of this severe energy shock, the stock market has shown surprising resilience. While oil prices were soaring, equities managed to hold their ground and even rally. In early April, the S&P 500 extended its gains into a 7th straight day. This marked the index's longest winning streak since October of the previous year. The rally was fueled by hopes the ceasefire could lead to reopening the strait. Investors seemed willing to look past the immediate disruption. The S&P 500 added 0.62%, closing at 6,824.66. The Nasdaq Composite climbed 0.83% to 22,822.42. The Dow rose about 276 points, or 0.58%, to 48,185.80. This performance seems counterintuitive. Typically, a major oil shock would send stocks tumbling. Yet, investors appear focused on corporate earnings, the path of interest rates, and underlying economic growth data that remain relatively solid. This resilience is not entirely new. Since 1987, the S&P has averaged 16% over 12 months after extreme bearish sentiment. While the index is down about 4% this year, it follows a stellar 18% total return in 2025. So, what does this all mean for you? The simple takeaway is that higher oil prices raise costs everywhere. They increase the price of gasoline at the pump and the cost of heating your home. But the impact goes much further. Higher energy costs drive up transportation expenses for every product you buy, which can lead to broader inflation across the economy. Businesses that use a lot of energy will see their profits squeezed. If prices stay high, central banks may adjust interest rate policy, potentially slowing the economy to fight inflation. For investors, the picture is complex and requires careful navigation. The immediate winners have been energy stocks and hard assets, yet growth and technology stocks have also shown surprising strength, suggesting the market is rotating, not collapsing. Many seasoned investors are advising caution. This is a time for careful analysis and risk management, not a time for bold, aggressive bets. It is a, working tape. A market that requires patience and a focus on quality, rather than a time to chase fast-moving trends. Looking ahead, there are several key items to watch. First, the day-to-day status of the Strait of Hormuz. Second, reports about production shut-ins and wells being brought back online. Third, official updates from the EIA and IEA. Fourth, the daily price of oil and its volatility. Fifth, how equities continue to respond. In short, the closure of the strait and deep cuts to production have raised the risk of higher prices for the rest of the year. Prices have already moved up very quickly, and yet stock markets have so far absorbed the shock with a degree of calm. The next few weeks will be critical. They will tell us whether supply can be restored and whether prices will recede. For now, plan for the possibility of higher energy costs and watch the news with a clear, steady eye.